Hello, and welcome to our second quarter strategy review. Once again, we met the end of March 22nd, right here in this room, to discuss the outlook for the next quarter. With me on my left is Bob Toomey, Vice President, Head of Research, and on my right, Len Skina, Vice President and CFO. Also joining us was Art Nunes, who is a local Northwest money manager, and we certainly appreciated his added input on the markets. Looking back though at the last quarter, we met at the end of the year and we saw the markets as being relatively reasonable, and we stayed with our basic allocations. However, as the quarter progressed, we saw headlines. U.S. stocks post worst 10-day start in years history. Bad January, a bad omen for stocks in 2016. And U.S. stock market may be having the worst January in history. I know that many of us were concerned, and also with the volatility that was caused and emphasized by many of these headlines. However, here at the firm, we said, is there something that we're concerned about that is happening that we didn't expect? And frankly, we couldn't see any. We didn't know, frankly, why the market was doing what it was doing. Consequently, the market, I guess, agreed, because it turned around in March, and actually we ended up for the month about 3%. So looking forward, once again, we do think that the economy looks pretty good. We think that the overall issues that were evidencing themselves early in the year are really not going to happen, frankly. So once again, as you'll hear from my colleagues, we continue to have overall a full investment strategy, and we even tended to overemphasize equities. However, we did make another decision at that meeting, as we frequently do, to look at what could happen to make us change our view. And we, of course, have called these triggers. People that have been following our quarterly reviews will note that we've had triggers, but we rarely have to use them. The trigger that we have decided on is a measure of the 10-year government bond yield. Currently at about 1.77%, we decided that the markets would say there's something that we should be concerned about if that rate went above 3%. Now again, that is not what we're expecting, but if it does happen, that would cause us to take some action, because it might represent problems in the future. With that, I'd like to cover the equity markets, or I'd like to have Bob cover the equity markets for us. Bob?
Great. Thanks so much, Stan. So I just want to follow up a little bit on Stan's comments that, as we look at the economy, as we left 2015 into the early part of 2016, we felt that the economy looks steady. As you're all aware, employment growth has been steady. The unemployment rate is almost down to where the Fed would consider that to be full employment. And generally, the economy is chugging along much as we expected, around 2%. And the U.S., of course, is one of the strongest economies right now in the world, particularly compared to Europe, emerging markets, and China, which is slowing down. If we look at various sectors of the economy, we see the services sector looks very strong. That includes healthcare and financial services, industries like that. Manufacturing has been weak, and that was part of what may have contributed to the weaker market in the second half of last year. But there's indications now that the manufacturing sector is starting to rebound and is being helped by a weakening dollar, which would be positive for manufacturing. Also, indicators like bank lending are looking good. Corporate loan growth has been running close to 10% the last several quarters, and that is also reflecting a healthy U.S. economy. With respect to interest rates, we still believe that they're benign. The Fed's comments earlier this week were very dovish, and we think the Fed is going to continue to maintain a very gradualistic approach to raising interest rates. In terms of the outlook for a GDP, we've been saying a 2.5% type real GDP growth. We continue to feel that that is the correct forecast at this point. We're still sticking with that. I just want to turn very quickly to U.S. equities. I mentioned that in my earlier comments there. We did have this correction in the fourth quarter. As Stan indicated, we struggled a little bit to understand why the market was so concerned. I think some of that had to do with energy. Some of it had to do with concerns over international growth. And I think some of it had to do with just pure trading mentality, that it was time to take some money off the table. But we believe fundamentally that there was no reason for that. So it's improving now because we believe the economic data that we're seeing is better, and we think investors are becoming more confident that the U.S. economy and corporate earnings will continue to improve as we move through the year. And that is our expectation, as we expect to see corporate earnings improve over the next several quarters, particularly in the second half. Some of that will be due to the anniversarying of the negative earnings that we saw in the energy sector. That will be going away as a drag on corporate earnings. And valuations, while I would say they're not cheap, at around 16 times forward earnings, we would not consider valuation to be excessive. And we think in this overall environment, it still is a reasonable valuation that can support higher equity prices on rising corporate earnings. With that, I'd like to turn it over to Len to talk a little bit about our international situation and the outlook there.
Thank you, Bob. Bob just described the domestic situation, and things look reasonably solid domestically. Internationally, the picture isn't quite as pretty, and there's really no area that we like anywhere near as much as we like domestic equities at this moment. We've looked at various regions of the world. China is slowing down. We don't really want any part of China, and as a result, we really don't want any part of the emerging markets either, because they're going to be much more impacted by such a slowdown. What we have done is kind of return to basics. We've looked at various regions of the world and decided we're not going to emphasize any one of them more than any other. What we're going to do now is look at our Developed Markets Index, the EAFE, which stands for Europe, Australia, and the Far East, and we are going to just basically play the index at this point. And we've neutralized our weighting, where we normally had for a while been much more heavily weighted towards growth. We've started to move towards a much more even weighting, and we brought our allocation to the value section up as well. With that, we are now almost at a 50-50 weighting there. And Bob will talk a little bit more about the reasons behind that when he's talking about changes we've made domestically as well, because we've made similar changes there. As we look forward from here, we are continuing now to de-emphasize the international allocation because, as I said, we really don't like anything there, so we're underweighting international. But we are continuing to, as our model always indicates, stay disciplined and remain in that broad index. With that, I'd like to turn it over to Stan to talk about REITs.
Thank you, Len. REITs, I think the fellows decided I should cover it because it's always been really one of my favorite sectors, and it's been a real stalwart with the firm for many, many years. But REITs today continue to do things for our portfolios that are very beneficial in the sense that they do pay out 90% of all their income. So therefore, the yield is quite competitive with just about anything out there. But in turn, we do see real estate, the actual real estate investments, do well because of relatively low interest rates. And remember, REITs represent only commercial properties. So they are invested in large office buildings, large apartments, and shopping centers. And these areas will, we think, continue to do better because There's not as much building going on, and therefore rents probably will tend to go up, again in a relatively low interest rate environment. With that, I'd like to turn it back to Len to talk about bonds.
Thank you, Stan. On the bond front, we continue to see interest rates as being something that the Fed is going to be raising on a slow but steady type basis. They're not going to go quickly. They're not going to do anything to upset the markets. And we view it more as investing for a low interest rate environment than a rising rate environment, because we do expect the Fed to go very slowly and very deliberately. With that, we're emphasizing the short end of the curve, because as the Fed does slowly raise rates, we want to take advantage of those new rates and turn over those short-term securities into higher interest rate securities as they are available to us. We're also continuing in the intermediate sector to use an actively managed bond fund for a portion of that allocation. And that actively managed fund is one that is going to give us an opportunity to better react to any changes that the Fed might make, and to be better able to represent that sector in a way that responds to changes in market conditions that may be a little bit unforeseen by us. With that, I'd like to turn it over to Bob for some changes in our model.
Great. Thanks a lot, Len. So one of the most important things, as Len mentioned in his comments, one of the most important things we did in this meeting is really looked at our allocation of growth versus value. And it's important because we do we do use both of those sectors in investing your money in your portfolios. We have been emphasizing growth for quite some time. Growth stocks in general have outperformed value stocks for a number of years. And we really believe that with a moderate growth environment, with valuations on growth stocks being extremely extended, we felt now was a very good time to increase our weighting in value stocks. And that's what we did. We increased value weightings in both large cap, developing equity, and as Len mentioned, international. We think that if corporate earnings growth, while we expect it to improve as we move through the year, if it remains fairly subdued, and I'm talking 4 to 5%, we think there's more opportunity for valuations of lower PE stocks to improve, whereas we think growth stock valuations have pretty much peaked out. And it's going to be more difficult for them to, I think, see an increase in valuation. So we really saw an opportunity for, I would say, a valuation play, if you will, in value stocks. In terms of our overall equity weightings, they did go up slightly because, as we said, we allocated a little more money to value stocks. We also added a position in industrial metals. And the reason why we did that, this is within our natural resources and commodity sector, which our model does call for. We did add a position in industrial metals because this sector got overly demolished, if you will, or really went down significantly in the recent market correction. The sector was down about 40%, and we felt it presented a really good opportunity to add some exposure there. In terms of other sectors that we continue to emphasize within the model, healthcare continues to be a strong allocation within the model. Home builders in the developing equity section continues to be a strong position of ours. We feel strongly that the home building sector does look good, and housing continues to remain one of the strongest areas of growth in the U.S. economy. As I mentioned, the demographics in healthcare and that sector continue to look excellent, and we feel that it's a very strong secular growth play. So we continued our exposure there. We did eliminate our position in financials, and the reason for that is largely because we feel that in a low interest rate environment, that the pop in earnings, or the upward pulse, if you will, for earnings was just not going to be as strong as we previously expected, and we felt that there were better opportunities to allocate money within the portfolios to attain better returns in other sectors, particularly value. And with that, I'll turn it back to Stan for wrap-up comments.
Thanks, Bob. And thanks to all of you for tuning in to our quarterly strategy review. I'd like to make sure everyone's aware that all of our previous reviews are on our website, and we invite you to look back and see, put some context to what we've been saying. As you can see, this quarter we are once again more or less holding the course with the expectation that the markets and the economy are in reasonable shape and probably going to move forward. We are concerned, obviously, as everyone is, about the potential action of the Fed and the potential raise in rates. So that's why our trigger was set that way. But again, let me emphasize, the triggers for us are things that we do not expect to happen. So that's where we are. We don't expect that to happen in the next quarter when we look at it again. And we'll be back with you the following quarter as well. So again, thanks for tuning in.